Good morning. Thanks for tuning in to September's topic discussion. I'm Nick Stern with Robert L. Stern Financial Services. I'm a certified financial planner here. Happy almost fall. I hope you all had a nice summer. I know I did. Really not looking forward to winter. All the indicators, Farmer's Almanac, what have you, is just pointing towards another horrible, cold, and snowy winter. Jumping right into it, September's topic discussion, I just wanted to talk about why interest rates matter. So if you've seen any financial news or news in general, you've probably heard or seen or read something about interest rates. The Federal Reserve left interest rates unchanged last week after their close of their annual September meeting. Why does that matter to us? Well, little backstory, a couple years ago, the Federal Reserve had said, well, if unemployment reaches X and economic growth reaches Y, we're going to be comfortable in raising interest rates. Well, more or less, economic growth is solid. It's relatively good or on par in the United States. Of course, it could always be better, but it's solid. Same thing with the unemployment rate. It's reached a number, or it's gotten down to a number that's acceptable that we could raise interest rates. The main thing I would say from the Fed minutes that I've seen is the global economy, meaning Europe, China, emerging markets, is not prepared for the rise in our interest rates. So why does the rise in our interest rates mean so much to the global economy? Well, that's just it. Since the 2008-2009 financial crisis, everything has become very interconnected, meaning correlation or how things perform have really gone up. So we're not on an island anymore, neither is China and neither is Europe. Everything is more or less interconnected. Now, each economy is going to be impacted differently. So if something happens in Europe, it's going to affect us somewhat, but it's not going to impact us as much as Europe, for example, or the emerging markets. I would say that the United States is relatively strong and positioned to weather any global economic downturn, but that's just my opinion. So anyway, why do interest rates matter? Well, interest rates have been so low for so long, and I think there was a lot of expectations that interest rates were going to rise. And they were going to rise a very little amount, but the reason why, or one of the reasons why they didn't, is because of the slowdown in China, for example, the potential back into significant recession in Europe, the trouble in emerging markets. So there are a number of different factors from a global standpoint as to why a rise in interest rates could potentially really negatively impact or fuel the fire of any negativity that's going on globally. There was also concern about a further rise in the dollar, which a rise in interest rates could actually happen. It could push the dollar up. There's also not a lot of indication that inflation is on the rise. So again, I think for those reasons, and from what I've read in the Fed minutes, is that that's why interest rates were left unchanged. Now, it could impact us a little bit when they do, and it seems like that's going to happen at least probably within the next year or over the next couple meetings that the Fed has. That could impact us on mortgages, for example, or credit card interest rates, etc. It's hard to say exactly what those are, but nonetheless, when it happens, there's probably going to be somewhat of a change or somewhat of an impact here. So that's really why interest rates matter. The reason why interest rates matter to the markets, the financial markets I should say, i.e. the S&P 500 or the Dow Jones, is that investors, the markets, Mr. Market, quote unquote, they like certainty. They like to know what's going on. And the uncertainty leading up to this meeting and then the continued uncertainty, the markets really don't like. The reason why they don't like that uncertainty is because, first, no one likes uncertainty. Second, no one can really make a reasonable forecast of where interest rates will be. Thus, they can't make a reasonable prediction of how certain investments or asset classes are going to perform based on that rise in interest rates. Thus, they don't think that they can make a profitable or potentially profitable trade, or investment. So the uncertainty leaves people guessing, and from a financial or an investment standpoint, no one really likes to purely guess. They like to make as an accurate a forecast as possible. But nonetheless, it's still a forecast. So that's where some of the volatility, in my opinion, in our opinion, has come from. You also have to think that we've been in a significant bull market since the 2008-2009 financial crisis, and up until last month, there really hasn't been any correction. A correction is typically defined as 10% or more on the negative side from a market standpoint. We hit that last month. We did recover, the markets did recover somewhat, and now we're back into this extremely volatile period. What I would suggest to you is, if you're, for example, looking at a retirement account and you're 30 years away and you're kind of uneasy, you're probably seeing some account fluctuations in your 401k or IRA, I would just urge you to remember your long-term goals and what that account is for. It's a different story or a different consideration if it's an account that you're going to use next month or you're going to retire next month, but nonetheless, just keep in mind your overall goals and what the money or what that investment is for. That being said, I hope this has been very helpful. I know the interest rate thing is or can be somewhat confusing, and it's just a question of why, but bottom line, we're in a global economy, and it's not just us. Economic growth in the United States is relatively solid. Same thing with the unemployment rate. Main reason, or one of the driving factors, is the impact that a rise in interest rates could have, or the negative impact it could have on the global economy, particularly with what's going on in China, emerging markets, and Europe. Volatility is really coming from uncertainty and people or investors or the market not really liking the decision coming from the Fed. I would say that's mostly coming from the uncertainty of it, because the Fed did not indicate one way or another when interest rates are going to rise. If you have any questions, there's a number, email, website at the bottom of the screen. Thank you so much for tuning in. I hope you have a great day.